There is a quiet yet unmistakable shift occurring in how serious investors view the Iraqi dinar, and it flows from patterns of economic behavior rather than social media claims or rumor-driven cycles. If one looks past the noise of speculation and social threads, what begins to emerge are signs of structural stability and policy choices that global markets watch closely before making any real allocation decisions. The primary backdrop to these observations is the fact that the Iraqi dinar remains anchored to a long-standing exchange rate framework. For the 2026 federal budget, Iraq's central bank reiterated an official exchange rate of approximately 1,300 Iraqi dinars per US dollar, a policy position that was maintained from policy decisions taken back in early 2023 and reaffirmed as part of government financial planning for the year ahead. This confirmation of the 1,300 IQD USD rate as the official benchmark anchors fiscal calculations and investor expectations by reinforcing continuity in how Iraq plans its national finances and external borrowing structure. On the ground, however, there is a notable spread between the official rate and what is observed in parallel market trading, that is, rates quoted by currency exchange shops and informal markets. In recent months, reports from local exchange markets in Baghdad and regional centers have shown the US dollar trading notably above the official floor, with rates sometimes around 1,420 plus IQD per dollar, and in certain outlets even reaching levels near 41 point IQD USD before settlement spreads narrowed slightly. This divergence is not necessarily a signal of imminent volatility, but rather a reflection of supply and demand conditions in unofficial segments of the currency market. It tells analysts that liquidity pressures, external demand for hard currency, and local market sentiment are still potent forces, shaping exchange dynamics on a day-to-day basis, but they do not override the underlying policy stance set by the Central Bank of Iraq, CBI. The broader context matters here. The CBI's mandate, as defined under its founding law and reiterated in official statements, emphasizes price stability and a stable competitive financial system, not speculative shifts or dramatic rate swings. By keeping the official exchange rate anchored and consistently selling US dollars to banks and the Ministry of Finance at predictable levels, monetary authorities signal to institutional investors that there is a preference for continuity over abrupt change. This consistency appeals to long-term players because it reduces policy risk, an essential variable when assessing emerging and frontier markets. Even global institutions such as the World Bank and other international observers note that stability in key financial metrics, including exchange rate frameworks and inflation controls, are prerequisites before considering deeper integration or capital placements. Another major signal investors are watching closely is how Iraq is managing liquidity, foreign exchange flows, and banking discipline in real time, not just on paper. Over the past year, the Central Bank of Iraq has made it clear that controlling dollar demand and tightening compliance within the banking sector is a priority, especially after periods where external pressure and regional trade flows created distortions in the currency market. One concrete fact investors monitor daily is the gap between the official exchange rate of roughly 1,300 IQD per US dollar and the parallel market rate, which at various points has traded in a higher range, often fluctuating between 1,420 and 1,480 IQD per dollar, depending on liquidity conditions and enforcement intensity. This spread is important because it acts as a real-time indicator of market stress, dollar availability, and confidence in the banking channel. Rather than ignoring this gap, Iraqi authorities have actively responded by adjusting dollar auction mechanisms, increasing scrutiny on international transfers, and requiring stricter documentation for trade-related dollar access. These actions signal to investors that Iraq is attempting to shift dollar demand away from informal channels and back into regulated systems, a necessary step for any country aiming to stabilize its currency environment over the long term. Another fact investors pay attention to is the volume and consistency of foreign reserves. Iraq continues to hold substantial foreign currency reserves, largely supported by oil export revenues, which provide a buffer against sudden external shocks. While exact figures fluctuate with oil prices and fiscal outflows, reserves have remained strong enough to cover many months of imports, which is a key benchmark used globally to assess currency resilience. This reserve position gives the central bank flexibility to intervene in currency markets when needed, reinforcing the credibility of its exchange rate framework. For investors, this matters more than speculation, because a currency backed by adequate reserves is less vulnerable to abrupt devaluation, driven by panic or capital flight. Stability in reserves combined with controlled currency auctions sends a message that Iraq has tools available to defend its policy choices. Even during periods of heightened pressure, interest also centers on how Iraq's budget discipline interacts with currency policy. The government's multi-year budgeting approach, including recent fiscal planning that assumes a stable official exchange rate, suggests a preference for predictability rather than experimentation. When a government plans salaries, public spending, and infrastructure commitments around a fixed exchange assumption, it reduces the likelihood of sudden currency policy shifts. A third set of signals investors are closely watching relates to Iraq's external position and oil-driven cash flows, because in Iraq's case, currency stability is inseparable from energy revenue management. Iraq remains one of the world's major oil exporters, with crude exports commonly averaging over 3.3 million barrels per day, depending on OPEC agreements and operational conditions. These exports generate the bulk of Iraq's foreign currency inflows, meaning U.S. dollar availability inside the country is directly tied to oil sales, global oil prices, and the efficiency with which revenues are transferred into state accounts. When oil prices remain elevated or stable, Iraq's dollar inflows strengthen, supporting foreign reserves and giving the central bank greater capacity to manage exchange rate pressures. Investors therefore monitor not just oil prices in isolation, but how consistently export revenues are converted into reserves and budget support. Periods where oil trades above key fiscal break-even levels ease pressure on the dinar, while periods of price volatility test the resilience of Iraq's financial framework. Another important fact investors track is how Iraq handles external payment obligations and trade settlement, especially as compliance standards tighten globally. In recent years, Iraq has worked to improve transparency in trade finance, including stricter controls on import documentation and international transfers. These measures have sometimes reduced the speed at which dollars circulate through the system, contributing to short-term stress in parallel markets. However, from an investor's perspective, this tightening is viewed as a necessary correction rather than a negative signal. Currencies become more credible when illicit or opaque flows are reduced, even if the adjustment phase introduces friction. The fact that Iraqi authorities have continued enforcing these controls, despite pressure, suggests a longer-term commitment to aligning with international financial norms. Investors understand that this alignment is often uncomfortable at first, but essential for sustainable currency stability. Debt management is another area drawing attention. Iraq's external debt levels, while not negligible, remain relatively contained compared to many peer economies, particularly when measured against oil-backed revenue capacity. This matters because high external debt combined with currency instability can quickly become a feedback loop of devaluation and rising repayment costs. Iraq's ability to service obligations without allowing debt pressures to spill into currency policy reassures long-term observers. When governments avoid monetizing deficits or forcing currency adjustments to manage debt, it signals fiscal restraint. Investors view this restraint as a stabilizing factor for the dinar, even if it does not translate into immediate appreciation. A fourth area investors are paying close attention to is institutional coordination and policy consistency. Because currencies do not stabilize or gain credibility in isolation, they reflect how well different parts of the economic system move together over time. For Iraq, this means alignment between the central bank, the Ministry of Finance, the banking sector, and broader government policy. One of the key signals here is that recent fiscal planning continues to assume a stable official exchange rate near 1,300 IQD per US dollar, rather than building budgets around fluctuating or speculative currency scenarios. When governments base multi-year spending, public sector wages, and infrastructure commitments on a fixed exchange assumption, it signals a strong preference for predictability. Investors interpret this as a sign that authorities are prioritizing social and financial stability over short-term experimentation. Sudden currency shifts can quickly translate into higher import costs, inflation spikes, and political pressure, outcomes Iraqi policymakers appear determined to avoid. Another important fact investors watch is how policy messaging behaves during stress. In markets, credibility is often tested not during calm periods, but when pressure builds. Over the past year, Iraq has faced episodes of dollar scarcity, widening spreads between official and parallel rates, and heightened demand for hard currency. Despite these challenges, authorities have largely maintained consistent messaging around their exchange rate framework, emphasizing regulation, compliance, and gradual normalization rather than abrupt policy reversals. This consistency matters. When governments frequently change narratives or signal uncertainty, markets respond by demanding higher risk premiums. When messaging remains steady, even under pressure, it suggests institutional confidence in the chosen path. For investors, this is a meaningful signal that policy is being guided by long-term objectives rather than reactive impulses. Banking sector behavior is also under close observation. Investors track how commercial banks adapt to tighter compliance standards, international transfer requirements, and evolving regulatory oversight. While these adjustments can initially slow transactions and frustrate market participants, they are often viewed positively by institutional investors. A banking system that operates with clearer rules, better documentation, and stronger oversight reduces systemic risk over time. Iraq's efforts to expand electronic payment systems reduce cash dependency and integrate banks more closely into regulated dollar channels are not headline-grabbing events, but they are foundational. Each step that improves transparency and traceability lowers the probability of sudden shocks that can destabilize a currency. Investors understand that these reforms take time and often face resistance, but persistence is what signals seriousness. The final and perhaps most important signal investors are watching right now is how expectations are being managed, both domestically and internationally, because expectation control is a cornerstone of currency stability. In financial markets, perception can move faster than reality, and when expectations become disconnected from policy capacity, instability often follows. Iraqi authorities appear increasingly aware of this dynamic. Rather than encouraging speculative optimism or denying challenges outright, recent policy behavior suggests an effort to keep expectations aligned with what the system can realistically support. This is a subtle but critical shift. For example, by repeatedly reinforcing the official exchange framework near 1,300 EQD per US dollar, while simultaneously working to narrow the gap with parallel market rates that have traded higher, often in the 1,420 to 1,480 IQD per dollar range, policymakers signal that normalization is a process, not an event. Investors understand that convergence between official and market rates rarely happens overnight. It happens through liquidity management, enforcement, and confidence rebuilding. The fact that authorities continue addressing the spread instead of ignoring it is itself a signal that market distortions are being treated as a policy issue, not a permanent condition. Another fact investors factor into expectations is Iraq's ability to absorb external shocks without abandoning its policy framework. Global financial conditions remain volatile, with interest rates, energy markets, and geopolitical risks all influencing capital flows. In this environment, many emerging economies face pressure to devalue or abruptly adjust currency policy to relieve short-term stress. Iraq's choice so far has been to rely on reserves, regulatory tightening, and fiscal discipline rather than currency shocks.